Welcome to the Deep Dive. Today we're going straight past the headlines. We're analyzing the Q3 2025 earnings call for Booking Holdings, that's ticker BKNG, which hit the wires after the close on October 28th.
And that timing, it felt pretty dramatic, didn't it? I mean, the whole market was worried about a U.S. travel slowdown, about macro uncertainty. So these results were, very highly anticipated.
Right. Were the fears going to be validated, or were we going to see real resilience?
And resilience is exactly what we got.
It really is. So our mission today is to unpack the numbers, sure, but more importantly, to get into the strategic story, to understand the insights from management that led to that really strong positive market reaction.
Exactly. This wasn't just a simple beat. It was a statement.
Okay, so let's start with that financial snapshot.
It was an exceptionally clean quarter. Non-GAAP adjusted EPS, for example, came in at $99.50. That's a robust 19% year-over-year growth, just blew past consensus.
And the scale of the business is it's still mind-boggling.
Yeah.
Total revenue hit $9.01 billion. That's up 13%.
And the big one everyone watches, gross bookings, came in at $49.7 billion, so up 13% year-over-year.
But the operational metric, the real story here, is room nights.
Absolutely. They grew 8% year-over-year, hitting 323 million. And crucially, that number just smashed the high end of their own guidance.
So it wasn't just a sudden rush of demand.
No, and management was really clear on this. They pointed to an expanding booking window. People are booking trips further out, which gives the company, much better visibility into future revenue.
Okay, let's unpack that operational excellence. Because when you see numbers like this in an uncertain economy, it usually points to some very disciplined cost control.
That's the hallmark of the quarter, really. The profitability gains were driven by efficiency. Adjusted EBITDA was $4.2 billion, up 15%.
And the margin expansion.
That's where you see the structural shift. Adjusted EBITDA margin went up to 47%. That's up from 45.8% last year. That's not just a little bit of creep, it's a fundamental change.
And a big piece of that has to be marketing.
Yeah.
The leverage they're getting there.
100%. Marketing expense improved to 4.7% of gross bookings. Last year, it was 5%. Now, 30 basis points might not sound like a lot, but at their scale, that is a huge amount of savings.
And it's all about a better traffic mix, less dependency on, expensive brand marketing.
Which leads right into their cost transformation program. They were so confident they actually raised the savings target. It went from, 400 to 450 million. Now it's 500 to 550 million.
When a management team raises a cost savings target by that much, they're finding some deep, sustainable efficiencies. Now, we do need to address the one, let's call it a discrete item in the report, that $457 million impairment on Kayak. Can you break down what a goodwill impairment means in plain English for everyone?
Yeah, of course. So goodwill is basically the premium they paid for Kayak years ago for the brand and its future potential. An impairment is the company formally saying, hey, the future value of this asset isn't what we thought it was. It's basically portfolio tidying.
So it's them acknowledging that the whole meta search business model is facing some serious headwinds.
That's it. They're signaling a move away from those legacy high-cost models and doubling down on their core engine.
An engine that's throwing off a lot of cash. Which brings us to capital returns.
Yeah, their stance here is very clear. They bought back $0.7 billion in shares in Q3. They still have a massive $23.9 billion authorization left.
Plus the dividend, $9.60, payable at the end of December.
It's a huge statement of confidence in their cash generation, even with all the macro uncertainty.
Okay, so let's pivot from the financials to the strategy, the flywheel. And it feels like everything starts with the Genius loyalty program.
It's absolutely a core differentiator now. Think about this. Travelers in the higher tier, so levels 2 and 3, they now account for a mid 50% range of all room nights at Booking.com.
Wow. So over half the business is coming from their most loyal, highest converting users.
Exactly. It creates this really sticky relationship that sort of insulates them from having to go out and spend a ton on marketing all the time.
And you see that directly in the channel mix numbers. The B2C direct mix is now in the mid-60s. A year ago, it was in the low 60s. That proves the theory, right? Invest in loyalty, and you rely less on expensive ads.
And the other pillar that's accelerating is the connected trip.
Right. getting people to bundle more than just a hotel room.
Yeah, and those transactions, ones with more than one vertical, grew mid 20% year over year. It's still a low double-digit percentage of all their transactions, but that growth rate is the key.
And the individual parts of that are growing even faster. Flights tickets up 32% year over year.
Over 17 million tickets in Q3 alone. And attractions, it's still a smaller base, but it grew close to 90%.
We can't forget alternative accommodations either. That's the big battleground.
And they're holding their own. Room nights there grew about 10%. It's now 36% of their total room night mix. So they're successfully expanding their inventory and growing in a really tough space.
Which brings us to the future, to generative AI. Management seemed very disciplined here, not just chasing hype.
Very disciplined. They focused on things that create clear, measurable value. For customers, it's things like AI chatbots at Agoda or Kayak's AI mode for trip planning.
Making search feel more human, reducing friction.
Right. But the really big efficiency win seems to be on the partner side of the platform. They mentioned Smart Messenger and auto reply, tools for the hotels and property owners.
And why is that so important?
Because happy partners give you better inventory and better pricing. They said partners using these tools reported higher satisfaction scores. So AI is creating real value for the supply side of the marketplace, making the platform stickier for everyone.
Let's shift focus globally for a minute. The U.S. acceleration was a big surprise for a lot of people.
It really was. Room night growth there accelerated to high single digits. And that was a mix of stronger outbound international travel and some real momentum in their B2B business. Crucially, they said they grew faster than the overall U.S. market, which points to market share gains.
In long term, of course, Asia is still the huge opportunity.
Yeah, management sees it as the fastest growing major travel market. They have a two-brand strategy there, Booking.com for the global reach and Agoda as the trusted local player. It's a really complementary approach.
And all this confidence, well, it translated directly into their raised guidance for the full year 2025.
Yes, that's the proof right there. They now expect full-year revenue growth to be about 12%, up from 10 to 12, and room nights to be up about 7%, which was previously 4 to 6.
Now, there's a critical nuance here for our listeners that we need to cover: foreign exchange. FX actually had a pretty positive impact on those Q3 growth numbers, didn't it?
It did, and it's a very important piece of context. It was a tailwind of about 400 to 500 basis points. So when you look at that reported 13% revenue growth, on a constant currency basis, it's really closer to 8 or 9% operational growth.
Still exceptional, but that context is vital for understanding the true underlying performance.
Exactly.
Okay, let's pivot to the big question that dominated the Q&A on the call, the moat. This persistent worry that generative AI, that LLMs are just going to disintermediate the entire business model.
Yeah, that people will just go direct to hotels or use an AI to plan a trip. Management's response was pretty firm. They basically called those concerns overblown.
Their argument being that the real value isn't discovery, it's execution.
Exactly. It's not the inspiration part, which an LLM can do. It's handling global payments, complex regulations, customer service when a flight gets canceled. It's the messy, real-world stuff.
Okay, but what about personalization? Can't an LLM just learn to do that?
Not without their data, and that's their first moat: loyalty and personalization. The Genius program is powered by deep proprietary transactional data. An LLM trained on the public web just can't replicate that.
And the second moat is maybe even stronger: their own internal use of AI for operational efficiency.
This was the jaw-dropper stat for me. Customer service costs are down year over year, in absolute terms, despite volume growing significantly.
So how are they doing that? How does AI pull that off?
It's intelligent triage. The AI handles 80% of the routine stuff, checking a status, changing a date instantly through chatbots. Only the really complex 20% gets to a human. By automating the bulk of it, they lower their cost per transaction.
And they said it actually leads to lower cancellation rates and higher customer satisfaction.
It's a classic case of better service at a lower cost. That creates an economic advantage that's almost impossible for smaller players to copy.
An uncopyable economic advantage. All right, and now for the segment that is strictly for conceptual exploration. This is not financial advice. This is for entertainment purposes only. It is not a solicitation to buy or sell any securities. Now, with that out of the way, given the themes on this call, let's pitch an outrageous but plausible trade idea.
Okay. Given the raised savings target and that accelerating B2C direct mix, we're calling this one the connected AI loop trade.
The connected AI loop trade. Lay out the mechanics for us.
It's a pair trade. You go long on Booking Holdings, BK&G, financed by a short position in a pure-play meta-search competitor, or another OTA that's still really shackled to high-performance marketing spend.
So the thesis is that Booking's cost structure is now fundamentally and permanently separated from its competitors.
That's the idea. The Kayak impairment was the signal. As Booking's direct business climbs into the mid-60s, their need to pay the toll to external channels like Google just diminishes. But competitors are stuck. They have to keep paying, and that cost is only going up. It creates a chasm in the cost of customer acquisition that just gets wider and wider.
Powerful stuff. Okay, so what does this all mean for you listening?
Look, I think we have three primary takeaways. First, profitability is robust and expanding, driven by real efficiency and proven by that raised savings target.
Second, their strategy is working.
Yeah.
The Connected Trip is accelerating, and the Genius loyalty program is deepening their moat.
And third, they're very confident in their ability to defend against AI disruption, arguing that execution and proprietary data are the real barriers to entry here.
The big narrative seems to be that scale and operational know-how are a defensive wall that simple tech can't just tear down.
Which leaves us with a final thought for you to mull over. Given management's conviction that their scale and deep operational data create an uncopyable advantage, where else in travel, or even retail tech, might a company's boring proprietary operational data, things like fulfillment, payments, logistics, prove to be the ultimate barrier to entry against the next wave of disruption?
A question that could define the next decade of competition. That's all for this deep dive. We look forward to exploring the implications with you next time.